Hey everyone, welcome back to Corporate Decoder, the place where we decode the money secrets of the big guys. Today we're diving into CNA Financial's August report. And let's just say things are getting interesting like a financial thriller, but with more spreadsheets. Before we jump in, make sure you're subscribed for more of these deconstructed reports, and don't forget to join our Discord community. The link is in the description below. It's where all the real talk happens. So CNA Financial, they're a pretty big name in insurance, and this report is all about a new deal they've made. It's not exactly a bombshell announcement, but it's a move that could impact how they raise money down the road. Basically, on August 5th, CNA signed an agreement with some major financial players like Wells Fargo, Citigroup, and JP Morgan. These guys are acting as the go-betweens, the underwriters for a new debt offering. What does this mean in plain English? CNA is borrowing $500 million. That's a lot of zeros. They're issuing these as notes, which is just a fancy way of saying bonds, and they're promising to pay them back in 2035. The interest rate they're offering is 5.20%. Think of it like getting a really big loan to fund their operations or expansions. To make this happen, they're using something called a shelf registration statement. This is a way for companies to get pre-approval from the Securities and Exchange Commission, or SEC, to sell securities like these notes over a period of time. It's like getting permission to sell candy from a vendor's shelf without having to ask for permission for every single piece. This specific update dated August 5th, permission for every single piece. This specific update dated August 5th is essentially the menu for this particular candy sale. The deal is expected to wrap up on August 12th. Customary closing conditions usually means everything goes according to plan, no major hiccups, and all the paperwork is perfect. It's like making sure all the ingredients are ready before baking the cake. Now, this filing also touches on their common stock. They're saying it has a par value of $2.50 per share. Par value is a very basic, often nominal value assigned to stock when it's first issued. It's not really related to the market price, which is what you and I usually care about. It also mentions their stock is traded on certain exchanges. One is the Chicago Stock Exchange, or XCH, and another is the big one, the New York Stock Exchange, or ENS. This tells us they're a publicly traded company on major markets, making their financial health and actions visible to investors. The currency involved in all this is the US dollar, which we know is USD, and the units being dealt with are shares, which represents ownership in the company. Signing off on this report is Starthy Darcy, who holds a pretty important role: Senior Vice President, Deputy General Counsel, and Corporate Secretary. This position usually means they're a key legal and governance person within the company, making sure everything is by the book. Now, let's put on our investor hats and think about what this means. CNA is borrowing a significant amount of money. This isn't necessarily good or bad on its own. It depends on why they're borrowing and how they plan to use this $500 million. Are they reinvesting in growth, perhaps acquiring another company, or just managing their existing operations? The fact that they're using a shelf registration indicates a proactive approach to capital raising, allowing them flexibility to tap the market when needed. For investors, it means adding more debt to their balance sheet, which could affect their financial leverage and potentially their credit rating if not managed wisely. The 5.20% interest rate is a key number to watch, as it's the cost of this borrowed money. We'd need to compare this to their profitability and other debt obligations to see if it's a favorable rate for them. Looking at the broader picture, CNA operates in a competitive insurance market. Their ability to raise this kind of capital suggests they have a strong enough credit profile to attract lenders. However, the insurance industry is also subject to risks like economic downturns, natural disasters, and regulatory changes. This debt offering could be a strategy to weather potential storms or to finance expansion into new markets or product lines. Without knowing the specific use of proceeds, it's hard to say if this is a move that will boost shareholder value or add undue risk. In my opinion, CNA appears to be making a strategic move to secure funding, signaling a commitment to future operations or growth. The transparency of using a shelf registration and the clear reporting of the debt terms are positive signs of good corporate governance. However, like any debt financing, it introduces leverage and must be carefully managed. The key indicators to watch going forward will be how effectively they deploy this capital and whether their earnings growth can comfortably cover the new interest payments. We'll need to keep an eye on their future earnings reports to see the impact of this borrowing. Alright, that's our quick decode of CNA Financial's latest filing. What are your thoughts on this debt offering? Does it signal confidence or caution from CNA? Let me know in the comments below. If you found this breakdown helpful, smash that like button and subscribe for more insights into the world of corporate finance. And don't forget to join our Discord community. It's a great place to connect and discuss these topics further. Thanks for watching, and I'll see you in the next one.